just crashed the stock market. Why do I say this? What does this mean? Welcome back to Brotherhood Finance. In today's video, we are going to be breaking down why I believe the Fed just crashed the stock market, how this is going to affect you, how you can prepare, and what this means moving forward. Before we dive into that, make sure to smash the thumbs up button, subscribe to our YouTube channel, and leave a comment down below. Furthermore, let's dive into this. If you don't know already, the GDP, gross domestic product, just went negative for the first time in quite a substantial amount of time. It was negative 1.4%. Now in our prior video, if you have not watched that yet, we addressed what the GDP is and what it means. Generally, a positive GDP means the economy is doing well, while a negative GDP means it is doing bad. Now what does that mean? When a GDP is negative for more than 6 months, which means 2 quarters, as there's 4 quarters in a year. So once we hit that 2 quarters and there's 2 negative GDPs in a row, that means we are in a recession, and we just hit the first quarter of negative GDP. Let's dive into this slideshow presentation. Let's dive into all this information right now. The 2-year Treasury yield tops 10-year rate, a yield curve inversion that could signal a recession. Now on top of that, we have bond market flashing recession signal as key yield gap inverts. In the last year curve segment to invert last did so in 2019 before we had the coronavirus pandemic and all of those things that occurred. Now, how can you prepare for this? What does this mean? Again, stocks have been getting crushed recently. A lot of the big markets such as the NASDAQ, the S&P 500, and the Dow, those big markets are now down more than 20%, which again, anything below 20% is signaling that we are in the start of a downward collapse or a recession. Typically, that marks bear market territory. Now, if you look at this chart right here, inflation is well above target and soft landings are rare. If you have not already known, the US and the Fed has printed a substantial amount of money and added money to their balance sheet. To put this into perspective, in 2008, they printed roughly $800 to $900 billion to get us out of the 2008 housing market or the recession. And this time around for the coronavirus, they have printed almost $6 to $7 trillion or more, really, depending on, they've been continuing to add to their balance sheet. So that just shows how much money they have printed. Now with that being said, they have to raise interest rates. So we've had 25 basis points, and they're talking about maybe even having 50 basis points increases, which again, how they control inflation is by raising interest rates, because when they raise those interest rates, it's costing you more money to take out loans, to buy a car, to buy a house, or really to buy an asset vehicle or get into the equities market, which is what we are focused on in today's video. Now, as I mentioned off this slide right here, the US economy shrinks 1.4% as concerns of a recession rise. So this is the first part signaling a recession. Again, we've had a multitude of videos before this one talking about why I believe we could very well enter a recession. You have to take into consideration that we have not actually had a recession since 2008, and I believe this negative 1.4% is the first warning sign that we could possibly very well be in a recession right now or in the beginning stages, but not a lot of people realize it currently at this state. Now, what does a recession signal? How does it normally end? Pandemic recession was the shortest ever in the US. So if you look at the typical recession, normally they last at least 10 months, and the first 6 months are generally the most brutal because the market is timing into advanced and forward looking as far as the recession. But on average, if you look right here, it about lasts for 10 months on average, and typically employment or unemployment is roughly 7%, 6.5% within that ballpark. So as this states, the Great Recession from 2007 to 2009, the recession lasted 18 months and required massive government stimulus to turn the economy around. So it was around, like I said, a $700 to $800 billion, they had to bail out really the financial industry, especially the housing market. Now, a lot of people may argue that today is a lot different than then, but really I think it's really on a larger scale. They've printed more and more money. We're even further in US debt. They have very low interest rates. markets. And really it's the perfect storm coming together in my opinion, and based off a lot of the other videos that we've brought to you on Brotherhood Finance. Before we dive into this further, please make sure to smash the thumbs up button if you've not already done so. I really appreciate you checking out Brotherhood Finance. And we have other videos such as how to prepare for the recession, how to get ahead, and how you can actually prosper from a recession, which a lot of people may not believe, but it's really the best time to take advantage while there is lower market values and lower equity prices. That way you can buy low and sell high. So that also makes it 15 years since that infamous tech bubble burst, sending the index down more than 75% by the time it hit bottom. You have to understand, although markets are already down 20%, I could see them going down even further. In 2008 to 2009 and around that time frame, we have seen the equities market go down about 50 to 60%. So we are having some rough times in the market right now, but that's not to say we could not go down further based on a lot of economical factors that are occurring right now. If you look right here, S&P 500 bear markets and recessions, it shows, it really compares recessions to bear markets. And again, the US GDP fell at 1.4% pace to start the year as pandemic recovery takes a hit. Again, that is the gross domestic product. That's showing that people are not going out, they're not buying as much goods and services, which means they don't have as much excess cash, which is showing that people are not having as much money to spend, which means slower economic growth, which is not good. That is bad to see, unless you take advantage and you watched our prior video on how to actually benefit from a recession. And analysts are pretty much saying what drives the decline is much of the first quarter decline in the United States was due to an increase in inventory investment, which had been booming in the final months of 2021. So let's talk about this. Why is there a falling GDP? Number one, there is the inventory investment. Maybe companies bought too much inventory. Number two, we have too much government spending. Number three, a decline of exports. And number four, there's also lower defensive spending that occurred as well. So all these things could be factored into that. However, these are what analysts are saying. I still believe that there is a tremendous amount of other reasons, such as the Fed's balance sheet, them raising interest rates, people not going out and buying as many goods and services, which is also lowering the GDP, and a lot of other factors as well. So Jason Furman, which is an analysis, says the much bigger subtraction was net exports, and exports fell and imports continued to soar. What this says is demand is strong as consumers and businesses are buying a lot, but supply is behind so much coming from abroad or being diverted from sales abroad. So he still thinks that although GDP is falling, it's because the exports fell and imports continued to soar. So that that's some counter active or counterproductive to what I'm saying about the economy. Now, what is Bank of America stating? They say a recession shock is coming. So you have these big banks, these big institutions really warning that a recession shock is starting to occur. And that's why, again, I believe, and we've been talking about, it's only a matter of time before the markets really retrace back down to adequate levels at which they should be, because when you dump a whole bunch of money into the equities market and the Fed adds all this money, it's only a matter of time before they have to start raising interest rates to lower inflation, because again, inflation is almost at a 30-40 year high. They need to lower inflation. How do they do that? By raising interest rates. The U.S. economy shrank at the beginning of 2022, as we've mentioned in these slides we've been going over, and stagflation could be next. We're starting to see huge drop in the markets that we have not seen before. Just last Friday, we saw markets drop anywhere from 3 to 4%, which is quite substantial for the equities market. Now, what is stagflation? Stagflation in the 1970s. Until the 1970s, many economists believed that there was a stable inverse relationship between inflation and unemployment. They believed that inflation was tolerable because it meant the economy was growing and unemployment would be at low levels. Their general belief was that an increase in demand for goods drove up prices, which in turn encourages firms to expand and hire additional employees, creating additional demand throughout the economy. In the 1970s, however, a period of stagflation or slow growth, along with rapidly rising prices, raised questions about the assumed relationship between unemployment and inflation. So, what is going to happen? Really, we're seeing that the opposite is what's happening in stagflation. You have too much employment, so companies are going to have to lay off people. You have high price of goods and services, while also the Fed is starting to raise rates. These are all things that are combining to really come together to possibly increase stagflation. Powell says taming inflation is absolutely essential and a 50 basis point hike may be possible. So not only may we see a possible multitude of 25 basis point hikes, but we may also see a 50 point basis hike for May. And considerably keeping that in mind, you need to understand that typically May is actually not a very good time to buy stocks. Typically it's a seller's month historically. So keep that in mind. We're already seeing the markets go down quite substantially. Wait until May when people really are usually selling their stocks, going on vacation, getting out, and for other reasons. It's just historically it's not a very good month. Now, what can we do looking back at all the recessions? Looking back at the 30 recessions between 1869 and 2018, there has been 16 recessions which have had positive stock market returns, as measured from the start to the end of the recession. These positive market recessions lasted on average 16 months, with stock returns ranging from 38.1 to 0.07%, with an average of 9.8% and an average GDP decline of negative 3%. Now, when you keep that in mind, as you can see, the average, drawdown during major recessions is about 30%. So that means we're about 10% away from reaching the average if we are currently in a recession. However, with that being said, you can look at this chart right here, stock market performance and duration in U.S. recessions, and you can see the S&P typically had a 1.7% increase and an average of 10.1 months during these recessions. Now, how can you benefit from this? And this goes back right to our prior video. You want to invest right back into the same economy you are in. So you want to buy low and sell high. So if we continue to have these low prices, this is not financial advice, but financial education, what might be good and considerable to do would be invest right back into that prior market. And if you look right here on this chart, after 3+ years, around 3 years, you'd have an average of 40.1% increase of return on investment, or ROI. So that is important to keep in mind. Now, again, that is why Warren Buffett loves crashes, why companies love crashes, because they know that they can invest right back into the same very economy, grow and scale their business, and get ahead and buy low and sell high. Now, what are some other indicators you can take into consideration to see if we are actually in a recession? This article states, we took the index as far back as the late 1800s and found that even going back that distance, we could still find correlations between economic crises and the completion of the world's tallest buildings, he said in an interview. Now, another thing, actually, believe it or not, that you can look at is the underwear index. Now, this seems kind of far off. Why do I state that? Typically, when underwear are being less bought, that means there is less financial gain, and that is showing a slowing of the economy. As you look in the slideshow right here, from 08 to 09, right before the big crises, we saw that underwear pricing and people buying underwear went down quite substantially. Again, brothers, I hope you found value in this video. Those are two things you can look into, what analysis are saying, why I believe the Fed has crashed the overall stock market, and we're just in the beginning stages. If you found value in this video, please make sure to share it with a friend, that way they can get ahead, they can be prepared. I hope you found value in this. As always, have a good rest of your week, a good rest of your weekend. Peace, brothers.